So dear all, Assalamu alaikum. I'm Dr. Habib Haider, consultant acute medicine and educational lead of APNE. Today we are here to discuss about the financial matters. Those are easily overlooked in NHS, but at the same time, they are very essential in modern day NHS. I'm extremely grateful to Dr. Nadeem Sajjad Raja and my moderators colleagues, Mr. Naseem Raij, Dr. Wajia Taniyat, and Dr. Zara Zekhar. Last but not the least, I'm thankful to Jonathan Godfrey and Andrew Coates to come forward and to discuss their experience and knowledge regarding these financial matters. APNE education team worked really hard to conduct all these webinars. We are planning to do some more webinars and seminars also in near future, which we'll discuss with you in detail at the end of webinar. Without a delay, I would like to pass forward to Dr. Nadeem Sajjad Raja, who is the General Secretary of APNE. Thank you, Raja Saab, for joining us.
Thank you very much, Habib, our educational committee lead. Association of Pakistani Physicians of Northern Europe, and we also call APNE, is a professional organization and learned society developed to promote high standards in medical education and practice, science and ethics, and now we can say that in finance. APNE also works to promote and protect the interest of its physician members. Another brilliant work, I must say, by APNE Education Committee, rather Finance Committee now, organized a much needed seminar on financial issues. No doubt it is a demand of the day. When frozen taxes here mean we pay more tax. People will pay more tax because 45% threshold is now 125,000. Rise in national insurance, pension changes, capital gain tax changes, limited company tax changes. We all know that HMRC is not going to phone to any one of us, and they will not help us in our matters. APNE will help you. We have a strong collaboration with strong financial team headed by Jonathan Andrew. Thank you very much, all of you. I am really obliged, Education Committee, Mr. Jonathan Andrew, Naseem Raij, Wajia Taniyat, Dr. Zara, and all the participants. So over to you, Habib.
Thank you so much, Raj Saab. I'm going to actually hand over to Mr. Naseem Raij to take the session onwards.
Thank you so much, Habib. Thank you so much, Raya Saab. I'm Naseem Raij. I'm one of the consultant surgeons in NHS, and I'm also part of different committees within APNE following the elected executive member. That's my brief introduction. I will then request my colleagues moderator, Dr. Wajia Taniyat, followed by Dr. Zahra, please.
Thank you, Naseem, and thank you, Habib. Good morning, everybody. My name is Wajia, and I'm one of the executive members of APNE. And we all work together to arrange these seminars and webinars for the benefit of our own community so that they can benefit. And this is one of those seminars. I will hand over to Zara for her introduction, please. Thank you.
Thank you, Dr. Wajia, for handing over to me. I am Dr. Zara Iftikhar, and I'm working as an Obs and Gynae registrar. And I recently joined APNE, and I'm really finding it very helpful for the Pakistani community, especially. So this was my brief introduction. So I'll hand over to Dr. Habib.
Thank you so much, Dr. Zara. I think I will now introduce our presenters, Jonathan Godfrey and Andrew. They are both from Regency Wealth and Management. They have got holistic financial planning for us. It is quite a complex issue we're going to discuss today, particularly pension, mortgages, and financial management. So I'll leave it to Jonathan to introduce himself first, followed by Andrew, please.
Yeah, hi, good morning, everybody. Good morning, APNE. Thank you for giving up your time on a Saturday morning after no doubt a very demanding week. So I'm Jonathan. And may I suggest that something that differentiates myself and my colleague Andrew, to start with myself, is I have spent and had the privilege of working with your profession for over 30 years in pharmaceutical sales. I was head of sales for Glaxo and then AstraZeneca, which means I understand doctors. I understand your profession. I understand how you're remunerated. We know what a clinical impact award is. And I work closely with my colleague Andrew, who is a licensed financial advisor. And let me define that. He is licensed by the Financial Conduct Authority, like you are licensed by the GMC. What we don't do is talk jargon. What we don't do is complicate things. This is a friendly chat between primarily Andrew, who understands wealth, with yourselves, who understands the health. And may I suggest that in the quite complex financial areas that Andrew is going to present on, you might want to take notes. We will have a question and answer at the end of his presentation, but also post this event, we invite you for a free, no cost, no obligation chat. And it is just a friendly chat with Andrew to personalize your financial advice needs and wants. So over to Andrew, please.
Hi, good morning, everyone. Yeah, as Jonathan's alluded to, this is an introduction to financial advice and what areas we can help and educate you in your busy life. So obviously, I've worked in the financial services industry for about 15 years through mortgages, pensions, investments, all the areas of where we assist clients. So today will just be an introduction more than anything of the areas of your financial makeup. And then what we can do, if there's a need or a certain area that you'd want to follow up, we can have a bespoke session on that where we'll up the complexity and start building on this base level of knowledge. Thank you.
Thank you, Andrew. Before you start your presentation, I just wanted to say something about the housekeeping. Every audience will be muted, so I'm requesting them to please write their questions whichever arise during the presentation in the chat box. All our moderators will pick up those questions and we can ask the presenter at the end of the meeting. Also, the question will be picked up from the live Facebook, and if some people who can't join here, if they're on Facebook, they can write the questions there and we'll be able to get the answer for those questions. And I believe at the end of you will have some contact details from Andrew or Jonathan to contact them directly for personal advice if needed be. Over to you, Andrew. Now you can start your presentation, please. Thank you.
Thank you, Nazim. Right, so you should all be able to see this now. So I won't dwell on me, but this is obviously my experience. I've worked in various financial institutions, from banks to estate agents to a national mortgage brokerage. And then the last 5-6 years, we've ventured into wealth management services, particularly pensions, investments, inheritance tax. So what we're basically looking to do is offer a partnership with APNI and your members to offer financial education and advice should you need it. We all know you've got very busy lives, and we'll try and accommodate you. It might be an evening, it might be a Saturday morning, to try and make sure that we've got a bit of a focus on where we're heading financially. So obviously you can see APNI there, you all know who they are. So Regency Wealth is the partner practice that I work under and advise under, and then basically we advise under St. James's Place Wealth Management. So the areas that I'm looking to cover today are mortgages, protection plans, investments. We'll have a look at pensions, and that will include some on the NHS pension. And then we'll also have a little look at inheritance tax. So I think the most important point to make is this will be fairly basic at this point in time. It's financial education and not advice. If you basically will need to come back for bespoke advice to try and take this forward. So It would just sort of broad brushing very quickly over the main areas, and then hopefully you'll be sat there feeling a little bit more empowered to make the right decisions going forward along with our advice. So one of the major points is that your financial journey, so if you're at the very start on the left-hand side, you might be in your 20s, 30s, you're just starting out, or you might be in your 50s, 60s, 70s, looking at inheritance tax planning. So we're able to work with you, whatever stage of this journey you are on. So as your financial situation changes, amends, our advice and our plan will also change. So it's definitely not one size fits all. And so you probably seen this on the news, unless you have been really busy. So obviously mortgage market has been in the news quite heavily over the last 2-3 months of rising inflation, rising mortgage rates. So the reason why the Bank of England base rate is going up is that inflation is remaining stubbornly high. So the government target for inflation is around about 2%. However, it's been in double digits, and we're now, as of May's figure, there is a month's lag with this, is currently 8.7%. So it's highly likely that until inflation falls to nearer that 2%, that we might see rates rise again. So if you look at this and you're thinking, right, what, my mortgage is about to come around in the next 6 months, next year, then the average 2-year fixed rate has now hit 6%, and then the average 5-year fixed has hit 5.67. The problem being that most people are coming off rates of 1-2%, as you can see on the left-hand side of the graph, and now heading towards 6 and 5.5%. So there is definitely a mortgage shock for most clients if they're remortgaging, and it will have an impact on the housing market. So essentially what the Bank of England are doing is raising interest rates to take money out of our pockets, to stop us spending, to bring inflation down. However, if we look at the external factors like the Russia and Ukraine war, obviously these are factors that we can't control. So it's highly likely the country will head into recession, and it's highly likely these rates might go up a little bit more before they start to come down. So in the ways that we can help you with mortgages are, we use Legal and General Mortgage Club. They represent the whole of the market. There's over 100 lenders that we can access. We can help you with residential purchases, remortgages, buy-to-let mortgages, limited company buy-to-let. So if you've got a buy-to-let portfolio in your own name, and therefore you're paying personal tax at that, mainly 40 and 45%, it's not very tax efficient. It might be more tax efficient for you to put that property into a limited company structure. Maybe not for you and your age group, but we also offer lifetime mortgages. So that's basically people releasing equity from their property if they're asset rich and cash poor. We work with some third-party providers to offer commercial mortgages, and then obviously anybody who has private pensions such as SIP and SASs, we can also look at that as well. So one of the main tips I can give you in terms of the mortgage market is obviously use a broker to find the best deal. Don't just go back to your existing lender. One of the crucial points is, so say for example, your fixed rate of your mortgage is coming round in December, you can fix that deal up to 6 months before that end date. So if you're in the opinion that rates are going to go up, then obviously you can fix your rate in, and as soon as your application goes in, it will secure that rate for you. So in terms of purchasing, we might have property prices just coming down over the next sort of 18 months. So if you are buying a new house, you've got to be mindful that that might be the case. There was some new help for any of the younger audience that might not be on the high salaries quite yet. The Chancellor announced certain help with mortgages yesterday, so you can have interest only for 6 months, or you can extend the term of your mortgage to help you bring down the cost while we get over this cost of living crisis. And that can all be done with no impact to your credit file, which is a really important point. So this is the government and the tax man trying to help the population get through this cost of living crisis. As you can see on the right-hand side, there's a power of overpaying graph. So this is based on a £250,000 mortgage over 30 years by someone overpaying by £100 a month. So if you have got excess income, they were able to reduce their mortgage term by 4 years and 3 months, and then save over £38,000 and well, 38,780 is the exact figure. So if you have spare cash and you overpay your mortgage, it will reduce the capital and reduce the term accordingly. And then finally, the best bit about working with someone who can do pensions and investments and mortgages is that they can look at both sides at the same time. So we're not going to do anything on the mortgage that will impact the pension or vice versa. So that's quite an important point. So we're going to move now on to income protection, life insurance, relevant life insurance, which I'll explain what that is, critical illness cover, and private medical cover. So income protection is probably your most important because it's the most likely event. You're more likely to be off sick than you are to have a critical illness than you are to die within your mortgage term. So the main points of income protection is you are basically insuring your medical career. So you can cover up to 65% of your salary. There are low start options where you would cover 2 years, or you can take it right to retirement age. So someone could cover themselves for £2,000 a month right up until age 67 if they were unable to work due to accident or sickness. I've done a quick example here of what cover might cost. So this is based on a medical individual age 30 at 65% of their £40,000 salary. It would cost around £30 to £35 a month, and those premiums will be guaranteed. Now, if your income is going to increase, you've got options to index, which means you can get the cover to represent your income as it grows in the future. So, for example, if you were off from the NHS on long-term sick, you're going to get 6 months full pay, 6 month half pay, and after that 12-month point, you get no money whatsoever. You might be able to claim statutory sick pay, which is about £80 a week, so not a great deal. This would then provide an income to make sure that you could pay the bills, look after the kids, feed the kids, whatever it might be. If we look at life insurance, then there's various different options. So providing a lump sum. So decreasing cover is to protect a capital repayment mortgage. So if your mortgage is 200,000 over 20 years, it will follow that mortgage down. So if, say, for example, in year 10, you owed £100,000, the policy is designed to then pay that £100,000 to pay off the mortgage. You can do level cover, so the premium or the benefit will stay the same. So you can protect your family with that. You can protect an interest-only mortgage. There's a fairly new policy called family income benefit. So that's rather an income rather than a lump sum. So a lot of people will do this if they've got children, especially if the children are young. They don't want their wife or partner to have a huge lump sum, but they've got to then budget for that over 20, 30 years. So that would provide a tax-free income for a period of time if unfortunately someone were to pass away. There is whole of life, which means it does what it says on the tin. So if at any stage it's like a guaranteed payout, people mainly use that for inheritance tax, and I'll cover that off a bit later in the presentation. So one of the main points, and the reason why I've written this in red, is your policy written in trust? So if you have a life insurance benefit of, say, £200,000 in trust, that keeps it out of your estate for inheritance tax planning. And it also means that the solicitor who's dealing with probate, who's going through your estate, doesn't need that. And the issue or the plan will issue within a matter of days, 10 to 14 days. If a policy is not in trust, it will get wrapped up in probate, and that will delay how the policy proceeds can get paid out to your family. So for people who haven't got an inheritance tax issue, it's how quickly we can get the money to them on our death. if they have, it can keep that money out of the estate. So if you have got an inheritance tax issue and you've got life insurance policy above and beyond that, you're going to lose 40% to the taxman for that. Your age and health determines the premiums. So the earlier you do it, the cheaper the premium will be. Every half birthday, the policy gets more expensive. And then the example below is really 40 years old, £250,000 level cover for 25 years would be approximately £23 a month. The same cover, but that decrease in one to protect the mortgage would reduce to 17. So it just gives you a rough idea of what premiums might be. In terms of critical illness cover, there's standard and comprehensive plans. There's generally about 40 conditions, but the main 4 conditions that are paid out for consistently are cancer, heart attack, stroke, and MS. You're paid out on a diagnosis of a critical illness. You don't have to pay the money if you fully recover. You'll see here that the premiums are much more expensive. So that's because you're more likely to get a payout. So the same £250,000 level cover is now increased to £152 a month. And then a decrease in plan is 103. However, if the premium is preventative, what we can do, so say, for example, you're in year 2 of your medical career and your income's reasonable, but you haven't got much spare cash, we can look to cover like a year's income or a year's salary. You don't have to cover the amount. So you can go on benefit driven or you can go on budget driven. So depending on the client's situation. In terms of protection as a whole, then protection is the foundation of any financial plan. So if you come down to here, even the best financial plans can fall down if you don't have adequate cover in place. So you can look to maintain income. You can look to protect your family members. You can safeguard your assets, mainly your house. If you've got existing plans, I would encourage you to review them. Things change, things improve in terms of the number of critical illness covers that now issues. A lot of partial payouts was not really a thing 10 years ago. Or we can implement new policies for you. And then make sure we use discretionary trusts. So we fill out the paperwork for you so that you don't have to do it, because we know if we just send it out in the post, it's very unlikely to come back. People generally don't understand what the legal wording means, so they will not fill it in. So basically, a policy in trust means that it's out of your estate to your family within 10 to 14 days, out of trust, gets held up in probate, and then gets delayed with the probate kind of review and process. So these are just some of the insurers that would use, some of the household names: Legal and General, Aviva, Royal London, Vitality. So similar to the mortgages, we'd have a search, find out what you want to do, and then basically find out the best policy that fits your circumstances. For any of you that have private practice as well, then relevant life insurance means you can pay the premiums out of your business and your family would still receive the benefits personally. So yeah, anybody private practice, corporate structures like a limited company, then speak to me, and then we can basically move your policy or your policy premiums from your personal bank account into your company bank account, but still then ensure the policy proceeds get paid out to your family. So this is moving on to savings and investments. So this is a pyramid that you should adhere to when looking if you're at the right stage of investing. So we should also, the bottom layer, we should always make sure we've got enough cash for a rainy day. So that might be £5,000, £10,000. There's no right or wrong answer. Whatever makes you feel comfortable that you've got the right amount of cash in the bank in order to start investing. So investing should be more of a medium to long-term strategy. And then within that, we'd start to look at tax planning and also estate planning. So the take-home point from this is you need to have a bit of money in the bank that's going to sit there for a rainy day in order for you to go on to level 2 and start investing. So I know obviously markets have been volatile. We've had quite a bit going on back end of COVID, a war in Europe, high inflation, and then lockdowns in China. So, but this demonstrates the power of investing and why investing makes sense. So I just want you to focus on the blue line, which is equities. So equities has historically outperformed any other asset class over a period of time. And that's despite things like the invasion of Iraq, markets came down. The banking crisis 2007, there was a large market correction at that point. More recently, we've had COVID, markets were down probably 20, 25%. But you can see there on the right-hand side that they came down, hit the floor, and then they bounced back. So if you then compare it to property, equities have outperformed, bonds that are deemed a bit more lower risk outperformed, and then obviously cash and then inflation. So equities, or the right proportion of equities in your investment plan, is the right thing to have to make sure that your money grows the best it can do. You just have to accept some rises and falls on that journey. So we have some investment beliefs that we adhere to, and I'll show you the right-hand side in a second. So obviously, what we do is we like to see clients receiving great client outcomes. We need to make sure that the asset allocation is right compared to your attitude to risk. We need to diversify, so we'll give you a range of assets, which the wagon wheel on the right will demonstrate. We use active management, so what we're trying to do is move money around to either make more money or to protect money. So the most obvious option for that recently has been the removal of UK equities. So the UK equity content has been reduced on the back of the latest budget, and basically the UK hasn't been a great place to invest over the last sort of 2 to 3 years. We do disciplined research, so we make sure we understand what we're doing, and then without or through our core range, we look at responsible investing. All our fund managers are registered with the PRI, which is the principle of responsible investing. So not only can we look to make money for ourselves, we also do it in a responsible way. So if I move on to the diagram on the right, this is actually a real life client situation. He has given me permission, obviously without his name on, to show you this. So you can see here, he's got lots of different asset classes. So Northern American equities, which is this blue column here, probably the asset class that has done the best out of the last sort of 4 or 5 years. Alternative investments, European equities. So your equities are designed to grow your funds, and things like your fixed interest, your property, your cash is designed to protect on a downward market. So we have things that are designed to grow and things that we design to protect. And what you want is a healthy balance of each of those according to your attitude to risk. So this is then his investment charts, and this is a typical 10 years of investing. So you've got to accept that probably 25 to 30% of investment markets are those returns that will be in the negatives. So what you will see that, so this is pretty typical. You've got some very good years. The highest one, the third one in, is nearly 23%. 3 on from that, nearly 20. So I would say out of a 10-year window, you might have 3 years that are very, very good, above, say, 8-10%. You would have 4 or 5 years that your standards, anywhere from sort of 3 to 8%, again, according to your attitude to risk. And then we can expect those 2 downward years. So if you look at his charts overall, despite him having 2 negative years, he's over doubled his money. He's 104.1% over that 10-year period. So trying to encourage clients to remain invested when markets are down is critical to basically achieving long-term growth. So don't panic when it's a natural cycle. It doesn't feel very good when it's going through a natural loss. However, we've got to go through them to look at the long-term gains. So in terms of what you should take away from this is ensure that you achieve step one in the period to make sure you've got enough cash to maybe cover 6 months bills, a year's bills, whatever makes you feel comfortable before you look at investing. Time in the market and not time in the market is crucial. So how long you're in the market is likely to determine that you will have more money at the end, not trying to time exactly when you put the money in. Nobody knows when markets will go up or down, but like I say, remaining invested is the critical bit. Diversification is key. Don't have all your assets working the same way. The assets should be negatively correlated. So that what that means is in any market conditions, some should be increasing, some should be holding, some might be going down. And then as the world evolves and markets evolve, then what was going up might be coming down and vice versa. So things will change, and having different assets for you to be investing in will just protect you and make you grow. So your eggs are not all in one basket. You need to think of the medium to long term and not in days. So if that client had just focused on those negative years, obviously it would be doom and gloom. It doesn't look very good. If he looks at the medium and long term, he said, oh, actually, well, I've doubled my money in that 100-year period. So you've got to look at this as medium to long term. And like I say, try and then go through the bad bits to then get to the good. And then obviously we can help you invest with tax efficiency in mind. Obviously, the government are actively trying to get everybody to pay a little bit more tax. So investing and trying to keep tax efficiently under control is a key point. So for those who will recognize the chap below, Albert Einstein, he said, compound interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it. So basically, the people who understand it invest and get that growth. People who don't, or maybe not in the position to be able to invest, unfortunately pays it. So compound interest is your friend. It will earn you money over the long term. So a quick few things, if anybody have got children on the call, so you can invest for your children. The most tax efficient is Junior ISA. You can pay £9,000 into an ISA. It's their money. So when they turn to 18, they get the cash. You lose control at that point too. So if you were going to put a large amount of money in, then obviously that might be a bit of a red warning for it. So depending on what your children are like at that stage, you might want to hold some control back. So you can invest £9,000 a year. And then the most important thing is that it's completely tax-free, no capital gains tax, and free from income tax. So not many people know that you can invest for children. So as a non-taxpayer, you can pay up to £2,880 into a pension, and the government or the tax man will gross that up to £3,600. So there's no access in a pension till age 55. However, that is is rising to age 57 from 2028 and is likely to rise further. And to illustrate the power of compound interest, so if you had a child and you invested that $3,600 from day one up until they're 18, they would have a pension at age 65 of just over 1.12 million. And that's based on about 7% a year. And then what this graph demonstrates is if you delay, so if you wait until they're 5 years of age, that 1.12 million reduces to 703,000. And if you waited until they were 10 years of age, you would reduce it further to 378. So you can see, because it's got a much longer term to grow, that's why the fund value is, and that is the demonstration of compound and the power of compound interest. So in terms of pensions, much of the same principles apply to investing. Obviously, this is probably long-term investing rather than medium. For those of you who have just got an NHS pension or on the higher incomes, then the NHS pension might conceivably be the only pension that you may have. So we're able to commission a 17-page total reward summary statement for you to be able to understand your NHS pension. What is it likely to give you? What options have you got? Could you put more in? What if you want to retire early? So without being able to understand the NHS pension, it's very difficult to make those changes or those decisions. The pension, so obviously you've started at a 2005 scheme, it's then 3-4 schemes later, you're able to put more in, or you have to put more in, you have to work longer. Some of them might be that you've got a bit in one scheme and a bit in another. So it's crucial to understand what you've got and how it works, and we're able to do that. What we don't do is just send you the 17-page document and say, there you go, we will disseminate that to you. So it's really about trying to help you understand your NHS pension so you can retire at the time that you want, knowing that you've got enough to retire. For some of you that might have been in private practice or have previous jobs before you entered the NHS, if you've got private pensions, we can look at that. What's my enough we'll come on to. So that's pretty much what everybody wants to know. If I retire, have then I got enough to do that? So without knowing that, it's very difficult to make sure that you've got enough to retire, because you don't know the calculations and what it might give you. So in terms of the pension regimes, we've now got much more options than we ever did before. So pension freedoms were introduced 7 or 8 years ago. It allows you to take your benefits more flexibly rather than just have an annuity that provided a guaranteed income for life. Again, there's some tax efficiencies in and around the new pension freedoms. We can now pass our pension down to our wife, husband, children, and that money will continue to be passed down until that money is eroded. So it's much more friendly and tax efficient than it ever has been before. In terms of IHT, so inheritance tax, then your pension is out of your inheritance tax equation. So it's not part, so any money that you have in a pension does not form that part of that calculation. And then the death benefits, like I say, you can pass them down to your family, even if you've started to use. There is basically, if you die before 75, you can pass it on completely tax-free. If you die after 75, it becomes taxable at their marginal tax rate. So if they're a 20% taxpayer, they'll pay 20% tax and so on. I'm not going to dwell on the lifetime allowance. That was effectively removed in the last budget. However, we've just got to legislate, if a Labour government come in next year, that the lifetime allowance might come back. So if anybody's on the call thinking they might have a lifetime allowance issue, so they've got a pension of £1 million plus, then again, that might be an area of advice that we can help them with. So to give you some rules of thumb to what a healthy retirement would look like, there is the main one that's 2/3 of your pre-retirement income to include your state pension. So if you're on £100,000 a year, you would want a pension of roughly £60,000 to basically give you the ability, because you might have a larger house, you might like your holidays, nicer cars, whatever it might be. So work on 2/3 of your pre-retirement income as a healthy retirement sum. If you have a defined contribution pension, which is a normal pension, what we would say is around about 4% is a reasonable drawdown rate for that pension to hold for a lifetime. So again, if you have £100,000 in your pension pot, it's going to give you roughly that £4,000 to £5,000 a year income. So you can see £1 million in a pension pot is going to give you £50,000. So you need quite considerable sums in your pension to be able to achieve the retirement that you want. In terms of the NHS pension compared to private pensions, NHS pension is 5 to 6 times better than an average private pension. So if you can maximize your contributions with the NHS pension, you are better doing that than you are doing a bit of both. You will have options of whether to take a pre-retirement lump sum. So you might say, right, I'm going to take the maximum lump sum initially and then have a lower income. Or some people might say, I want a higher income and I want a lower lump sum. Again, most people will probably take the maximum lump sum that's available to them. So the point at the bottom, ensuring your beneficiary forms are filled out. So that's making sure that your family are nominated, a bit like a will, to make sure that your pension goes to who you want them to go, for it to go to. So looking at this, we have our pension fund, we remain invested, and this isn't a drawdown. And what we're trying to do is get our pension, if we are no longer around, to our beneficiaries, like I say, it could be wife, children, grandchildren, whoever it might be, as tax efficiently as possible. With these advice, a part of the follow-up is we would understand your situation. We would plan this out along with your advice and guidance. We design the plan, and then what we do is review it. So we're not just here to do a plan now and you'll never see us again. Every 6 to 12 months, we'll follow up that plan and make sure it's on track. So I'm just going to breeze over inheritance tax. So this is probably a bit more complex than the other 3 areas. So at the moment, what's happening is that the inheritance tax thresholds have been frozen until 2028. So as an individual, you get £325,000 of nil rate band. As a married couple, you get 650. So if you're married, you basically inherit the deceased person's 325, so therefore you get 650. And then there was the introduction of the residential nil rate ban, which is a further 175. So as a single person, as long as you're leaving your residential property down to your direct descendants, i.e. children, you get that extra bit. So a single person, 500,000, and then a married couple, £1 million. So basically, inheritance tax is based on anything over that £1 million or that 500,000 is 40% tax. So it's quite an expensive tax to pay. You can see here the backdrop. So 6 billion the Chancellor had got in, or the taxman, in IHT receipts in 2021. And that's up from £500 million the previous year. And it's estimated to get to 7.8 billion by 2028. So the main reason for that, if you look at the picture on the right, is our property prices, especially down in the south. Property prices have been rising for years and years. The inheritance tax levels and limits have not been increasing. Therefore, more people are paying tax and going over it. So very quickly, you have if you wanted to gift money to your children, if you have an inheritance tax liability, you've got a gift exemption of £3,000 a year. If it's a wedding gift, it can be £5,000 a year. And small gifts, it's quite a strange one, but you can give as many people £250 a gift individually as you want. So if you wanted to stand on the street giving people £250, you could do that as many times as you wanted. You can give away as much money as you like, but it's classed as a potentially exempt transfer. That means we have to live for 7 years before that gift comes out of our estate. It's to stop someone with, like, say, a terminal illness with less than 12 months life expectancy signing over their house and giving away their assets without the taxman receive any benefits. So if we need to plan early, but you need to look after yourself first and not look after your IHT. So we can put life insurance policies in trust, like we said. That keeps it away from the taxman, make sure the premiums are paid to the beneficiaries as quickly as possible. One of the main problems with inheritance tax is the taxman wants their tax before you can realize your say if it's your parents, their assets. So what that means is, so say for example you owed £100,000 inheritance tax because your mum and dad had unfortunately passed away, left you the estate, but there's £100,000, but you need to pay that £100,000 before you can sell the house, encash their assets, use their cash. So by putting things like life insurance policies in place, we can put that £100,000 in your pocket to pay the taxman before probate is issued. The other way of doing it is you would have to take out some forms of bridging finance, which is expensive. It'll cost you money to do that. So again, it's about making sure that we have provision for that. I'm just going to give you a brief example of what we did for a recent client. So the client had an inheritance tax issue. They didn't have any children, so they didn't get that extra nil rate band. They had £300,000 in ISAs. We moved that into an investment bond called a loan plan. The benefit of that was any growth that loan plan or that investment bond makes is immediately out of the estate for inheritance tax purpose. So if that ISA had grown by £100,000 over 10 years, that IHT bill would have gone up by another £40,000. If we put it in the loan plan, then basically we've saved that £40,000 from the tax man. In a loan plan, you're loaning money into the bond and not gifting, therefore you can still get access. There are different types of investment bonds, gift plans, later life planning scheme that look after things like care home fees. So it's all about trying to move money at a certain stage of life for things that are going to cost the estate inheritance tax to things that aren't. This is all legal and above board. It's just the right advice to try and mitigate IHT rather than avoid it. So I think the main takeoff points of what we've gone through is that you're likely to need different aspects of financial planning throughout life. We're here to guide you, educate you, and advise APNE members of all aspects of financials, whatever that might look like. We offer bespoke, expert, and tailored advice. So what might be right for you could be completely different to your next door neighbor according to your basically goals and aspirations in a similar financial situation. Expert planning is critical. So especially when we get to inheritance tax, it's really key that you get the right advice. And then one of the main reasons why we work in the medical sector is we find that your busy lives in and around your medical profession, and obviously your busy lives with family, is basically a barrier to getting the right advice. And we've just got to spend a couple of hours every sort of 6 months or so making sure that we give some focus. What we're offering is a discovery meeting. So that means me finding out about your situation. We can discuss where you're at, where you'd want to be. There may be several areas that we identify and you can prioritize that. These meetings are at no cost or obligation. So if it's not the right time to do anything, we can park it and then you can come back to us when you're ready. If you are in a position where you want to proceed, then obviously we'll identify the costs, so you'll know what the basically the advice costs before you proceed with that advice. So we went through a discovery meeting with Habib. So I'm sure he found it useful. So like I say, I'm not sure if you'll say a few words on that, so how we found it useful, but it's really for me to understand your situation and then I can guide you going forward. So finally, myself and Jonathan, we're available for follow-ups. So obviously I'm the financial advisor who will deliver the financial advice. Jonathan, he'll basically be able to explain a bit more about what we do, and then obviously you can make appointments on my behalf. So in terms of what we've gone through 4 or 5 of the major areas of anybody's financial makeup. It's designed to give you a bit of education, set the backdrop for advice, not really advice at this stage. And then, like I say, if you want to take that forward, then please contact us. So I hope you found that useful. If there is a desire for something a bit more complex on a certain area, then that's what we can deliver and start to really add some meat to the bones in terms of the complexity of things. And we'll pick an area or a couple of areas to focus on next time. So like I say, thanks very much for your time. I appreciate it. It's Saturday morning. I hope you found that useful. Thank you.
Thank you so much, Andrew. It's really been eye-opening for me, and I'm a bit more confused now. So consider me your first client. I think I'll be your first client after this to contact you to have some more solutions for my problems. I have got a few questions from the chat box and some other questions maybe from Facebook area. So I will let Dr. Vijaya ahead to ask some questions from you first, please.
Thank you, Naseem, for handing me over. So we've got quite a few questions from our chat box. So one of the questions which was asked by our previous president, Dr. Irfan Akhtar, he asked that how could we get personalized codes assessment?
Personalized what, sorry?
Personalized code. A personalized codes assessment. You're muted, I think. I can't hear you.
Can you hear me now? Right, you've got on mute now.
Right. I think the question she was asking was from one of our ex-president.
Yeah.
That you. The first question he was asked. Yeah, how could we get the personalized codes and assessments?
Is that for the NHS pension you turn into?
Can I ask Mr. Irfan Akhtar, immediate past president, please ask a question straight away.
Yeah, let's
Unmute yourself, please.
I think Irfan Bhai is busy, so he probably that's why he passed the question. I gave him option to unmute himself, but I think he's probably not able to ask question himself. So can somebody ask on his behalf, please, as he said before?
Yeah, his first question was, I believe, is maybe around pensions or something, because he was asking how could you get personalized codes and assessments. We can ask him later on about the clarity of it. Let's go to the second question, which is asked by Dr. Aisha, and she's asking, do we really need a life insurance while pension can pay off the mortgage in the event of death, or life insurance as they think is min or halal? So what are your suggestions?
So in terms of it, if you think about life insurance or a pension amount, it might just pay off the mortgage, whether that's enough. So you've got to then, so say if you're, especially if you're the main income earner, paying or having a pension that's just going to cover off a mortgage, then obviously it's all the council tax, the bills, raising the children, that kind of thing. So we do a full assessment. If your pension is really big and obviously the death benefits are really good, then yes, we'd do an assessment to whether you would need that or not. If your pension is not going to cover those bills and put the right amount, then obviously you might be a combination of both. So again, assessment needs to be made to come to that judgment, and then we'd advise you accordingly.
I hope that answered Dr. Aisha's question. Next question is again from Mr. Irfan Akhtar, and he asked, can we have an elaboration on McLeod questions decision and how it will affect people in 1995 and 2015 scheme?
So the McLeod judgment, so look, we probably need a session just on NHS pension to cover that. The changes in the NHS pension have been substantial. So it's probably not, we could talk all day on that, I think. So I think if anybody really wants to understand their NHS pension reports because the scheme has changed that much, then let us know, and it might be that something that we commission the report and then we could have an example report on the screen to go through what's changed. So that the 2005 scheme or the 1995 scheme is obviously much more generous than the 2015 scheme. So that's a big question to answer, and probably something that we couldn't answer all in one. But the main point is you've got to understand your NHS pension to be able to make sure when you retire you understand what you so yeah, I can see there's a chat saying worth organise a seminar on pensions. So yeah, it would be a follow-up might be about NHS pension that we could do for you.
Well, the next question was would like to know, is from Dr. Shafiq Ahmed Chugtai, would like to know more about income protection in the event of a loss of regular income, how long regular income will be guaranteed? Does it cover the loss of income due to sickness only?
In terms of the question, so there was a couple of points there. So you can do a cheaper policy that will just cover 2 years, or you can cover your income right up until retirement. So if you were 35 covering £2,000 a month, you could take that right to age 67. So obviously, if you're only covering 2 years, it's a little bit cheaper to do than the policy that takes you to age 67. In terms of what the policy pays out, if you are unable to work due to accident or sickness, so any condition, could be mental health, could be a broken leg, whatever it might be, then you're eligible to claim. It's not like critical illness where you need to hit a specific diagnosis to be able to claim. It covers everything.
Thank you, Andrew. Next question again from Mr. Irfan Akhtar. How has the annual allowance really affected a consultant?
So the annual allowance is effectively been withdrawn or removed entirely, which caught us by surprise from April 2024. So if that remained in place, then there's no upper limit to how much you can have in a pension. Therefore, those people were getting tax charges because they'd gone above the 1,073,100 you can have into a pension. That won't be happening in the future. What they haven't done, though, is increase the amount of tax-free cash. So it's just over 253,000 that you can take as tax-free cash. So for your high-earning consultants that have the high pensions, what it means is that if that stays in place, which is a big if, there is no lifetime allowance tax charges. So you could have 10 million in the pension and still not get tax charges. So it's more advantageous. This has really helped the high earners in terms of consultants who might be of a certain age and experience. It's really done them a favor by doing that. Whether the Labour government come in and change that, we'll have to see. But like I say, it was the main reason why it went up was because experienced consultants on high earnings and high incomes with really good pensions were retiring from the NHS early because they couldn't put as much money into their pension. Therefore, it wasn't very tax efficient.
Thank you. And I think there's a supplementary question to it, which says, same from Irfan Akhtar, with the current changes, how has the retire and return evolved?
Obviously, in terms of cost of living is high, so we need more in our pensions than we ever have done before. And then basically what's happened, the main sea change is 20 years ago, people used to retire, probably live for 10 years, and that was it. Whereas now people have got to budget for a 20, 30-year retirement plan. So you've got to have more money because you might have to make that money last for a longer period of time. So it's obviously longevity is causing an issue in the market that we have to have better pensions than we did before. And then in terms of the state pension, so that's been going back. So it's now, I'm 43, mine's hit 68. It's likely to become 70 in the next sort of 50, 100 years. And then if life expectancy and longevity doesn't follow that, we may be in a situation where we start to means test the state pension, where if you are a high earning doctor with healthy assets, that you might not get a state pension. I don't think that will happen or impact you, but the kids of today might grow up with the fact that then there might not be a state pension for all that we've grown up with. So lots of people with the final salary pensions are probably all going to pass away in the next 20 years, and the younger generation aren't going to have as good pensions. So we've got to budget for living longer. We've got to therefore put more into our pensions. And then obviously we've got to expect that the state pension's going to go back a bit further. But if you wanted to retire at, say, 60, but you're not going to pick up your state pension until you're 66, then you've got to work out how you're going to fund that 6 year out of your own money and then still have enough money to retire in full on. So there's lots of different things going on. And this will be a situation that evolves going forward.
Thank you. Before I pass it to my other colleague, Dr. Zara, I got a personalized question where Dr. Maher Ahmed has written that he 66-year-old GP working full-time in the process of buying a property. So would he get some advice from for the finance from yourself?
Yeah, absolutely. So if he, I can bring up right at the end, or I'll put my details on Jonathan details in the chat. So that's probably a phone call or a Zoom meeting just with ourselves to go through things, what options he's got.
Right.
I just wouldn't want to discuss his own personal situation in front of everybody else, that's all.
So I think similar supplementary question from one of our colleague, Dr. Kabir, Mr. Kabir, and he has our same question, like he's a 40-year-old consultant working full-time and starting to save with view to buy the property next year, and he also needs some advice on finances. So
yeah, perfect, same. So yeah, that would warrant a bespoke meeting just ourselves where we'd understand what you're looking what they're trying to achieve, and then we can put plans in place, whether again to put that property into personal name or whether to put it into a corporate structure. Like I say, all that sort of thing will be discussed at the time.
So I'm just collecting questions from chat box. I'll pass it on to Dr. Zara to ask a few questions before I put you back on the chat box question later on. Yes, Dr. Zara, please.
Thanks, Dr. Varaj. So the next question is asked by Dr. Khurram Naseem, and he has a question regarding pension. So he asked that in my total reward statement, NHS BSA have calculated my accrued pensionable income under 1995 scheme from August 2010 to March 2015, and total length of pension 10 years, which is from February 2005 till 2015. So he asked that my pensionable income from February 2005 till August 2010 has not been mentioned in that statement. Does that affect my pension benefit calculation?
I think we'd have to look at the report. So it's quite difficult to answer that without seeing the full report. So we work with another colleague, another Andrew, who basically is a specialist on NHS pensions. So it's if we arrange a meeting or a call after this meeting, then if we can see the report, then I can start to dig into that and basically give him the right advice. It's a big question to answer without seeing the report.
Okay, thanks, Andrew. So the next question is by Dr. Hisham Haq. He is asking that, can you advise about SEIS investment?
Yeah, so I didn't touch on the more complex areas of investment. So there's certain tax advantage products, VCTs, EIS, which means the government, so they're quite higher risk. So again, it's not really a foundation level conversation. So for people with income tax issues, they can invest in VCTs, which gives them a 30% tax break. And then they can either take the tax break away or reinvest, and or you've got EIS, which is to deal with inheritance tax, but you're probably looking at a small portion of the population that can deal with things like that, and that's probably an area of a bit more complexity, which I think some people would set it's over their head. So certainly we can, yeah, any investments, whether it's tax advantaged or your traditionals, we can basically deal with.
Dr. Zahra, sorry to interrupt you. We have President of Apne, Mr. Amir Khan. He was in a hurry. He would like to say a few words before he leaves. So sorry about that. Just we're going to hold the question for a few minutes. Mr. Amir Khan, please. Mr. Amir Khan, can you hear us?
He's muted, I think.
Hello?
Yeah, we can hear you.
Can you hear me now? Oh, thanks very much, team, for organizing it. It's been a very good seminar. Andrew, thank you very much.
My pleasure.
Enjoyed it. Yeah, I think there are quite a few. I think most of us have got lots of questions, and it might be worth us putting your details there so we can have one-to-one meeting with you afterwards. And I was just observing that I think there's so much people have got about pensions. So it might be worth doing the whole seminar on pension because there have been so many changes.
Yeah.
For both those who are already working and the ones who stopped working and gone back, just to understand where we are. So thank you very much, and please enjoy the seminar. I'm sorry, my apologies because I have got to go, but I'll watch the recording afterwards. Thanks.
No, thank you. Thank you, Mr. Amir Khan.
Thanks, Habib. Thank you very much, Habib. Thanks, Ajit. Thanks.
Thank you. Thanks. Yes, Zara, you can continue now. Sorry about that.
No problem. Thanks, Dr. Habib. So the next question is by the same person, Dr. Hisham Haq. He is asking about the tax advantage when investing in the medical technology.
We wouldn't, I mean, we'll deal with certain stocks and portfolios, but we wouldn't have a route of which to directly invest in medical technology. There may be some of our portfolios and funds of funds that would invest in either tech or medical technology, whatever it might be. But we could certainly, we work with a discretionary fund manager, so they're more bespoke portfolios. So if that was an area of investing, then we can look at that. So basically what I would encourage someone to do is basically have a follow-up. If they want to invest in a certain area, then we'll go and find out the ways and what and how we would achieve that for them.
Okay, thanks, Andrew. So Dr. Khurram Wasim is saying thanks to you, and he's going to arrange meeting with you. And he's asking that, is there any benefit of stopping NHS pension and starting SIPPS investment?
Yeah, so look, SIPs are a self-invested personal pension plan. The main reason why someone would want a SIP over a standard pension is they can hold commercial property. So say, for example, you're a GP and you wanted to own the building, your pension could own that. Would you want to stop your NHS pension in order to do that? Probably not. I think you could have a combination of the two. I don't think it would be very sensible or generally tax efficient to stop your NHS pension to start another pension. While the NHS is basically giving you 10 to 15% of match contributions, I would take that all day long.
Okay. Next question, Andrew, is from Arsalan Arif. And he's asking, is it beneficial to transfer NHS pension to HSC Northern Ireland pension and then back to NHS if changing jobs between England and Northern Ireland? And he is in 2015 pension for both.
I would say that's so that the NHS pension will have its own NHS trustees who basically are responsible and look after the pension fund. I would say that's more of a question for them because it will be scheme rules. They might allow that or they might not. Whereas if it was say a legal and general defined contribution pension, then we could give advice on that. But if it's NHS, similar to someone with a final salary pension, it's generally the scheme rules that determine what you can and you can't do. So I would contact NHS Pensions Direct and ask that question, and they'll basically tell you if they would allow that or not.
Okay, thanks, Andrew. So, Andrew, now I have a couple of questions from you. So, if you can tell me that, how could I protect my income with protection policies?
So look, the major things are like what we've gone through. So income protection, if I can't work, then I put some cover in place to make sure that that I can have an income for life. So especially if you imagine a surgeon in training, say if they're an ST3, they want to make sure that they can continue their NHS career. And if they can't because they've had an accident or an illness, then they've basically insured their income going forward. Obviously, life insurance we've touched on, and then critical illness cover. So you're more likely to have a claim on income protection than you are on critical illness than you are on life. So that's the order that you should do things. But people will generally go for the life cover first because it's probably the cheapest. So you're putting your cover in a place where you're unlikely to claim compared to the other things. So ideally, we'll have a bit of everything just to cover those 3 scenarios off.
Okay. And Andrew, what does a trust do for my life insurance policies?
So yeah, we've kept that out of the estate. Make sure we put the right money in the right hands as quickly as possible. And then if we've got an IHT issue, then we've saved it from the taxman. So 100% of the benefits can go to your family rather than the taxman.
Okay. Okay, so let me have a look. Okay. No other questions. I'm just having a look at the chat box that if anybody has any more questions. So Dr. Habib has a question. Okay, so what would be a sensible amount to retire on compared to my employed income?
Yeah, so we touched on that. So if you head for 2/3 of your pre-retirement income as a reasonable thing to aim for or amount to aim for, or if you're in a defined contribution pension where you're trying to build up everything yourself, you can basically say for every £100,000 worth of pension pot, I get £4,000 to £5,000 of income back from that. So if I want £25,000, I'm going to have £500,000 in the pension pot. So there's a couple of ways of looking at that scenario.
All right, thanks, Andrew. And the next question is about the mortgage. So Dr. Habib wants to know that how soon before my existing mortgage fixed rate ends, would I be able to secure a new fixed rate?
6 months. So the market's moved forward. So it used to be about 3 months. So your bank or building society would send you a letter about 3 months before and say, look, we're going to offer you a deal, or we're not, just to make you aware that you're coming off your deal. What we were able to do is basically remortgage somewhere away from somebody away from that existing lender 6 months before. So they've moved to 6 months. So if you are staying with the same lender, you can generally reserve a product now, and then that product won't then come into force until your fixed rate is up in 6 months' time. If you move to another lender, you apply for that mortgage, you fix the rate or hold the rate as it is, and that will only go through once that existing fixed rate is done. So 6 months. So if you think that interest rates are going to go up a bit further, which I probably do, then 6 months. So the sooner the better. The nearer the 6 month window, the better you are.
And how much could I borrow?
I'd say a rough rule of thumb is about 4.5 times income. So generally work on like an affordability calculation. But if you were to say, right, well, if I'm on £50,000, then I can generally borrow 200 to 250,000. Some lenders might lend you a bit more. Some lenders might lend you a bit less. Scottish Widow have a professional range, which for GPs, doctors, consultants would be about 5 times income, because they generally know that your income will just keep on going as you go through the levels and higher qualifications and levels that you would go through within NHS. So anywhere from 4 to 5 times income, depending on your circumstances, will give you a rough ballpark figure. If anybody's in that situation, you can email me, ring me. I can probably get that information within about 10-15 minutes.
Okay. Andrew, the next question of Dr. Habib is regarding investments. So he's asking that, do I have enough cash savings to warrant starting investing?
Yeah, so if you remember that pyramid, so again, there's no right or wrong answer, but what you shouldn't do is invest if you haven't got enough cash to fall back on. So some people might like 6 months of income in the bank. So you're not looking to really get lots of return and interest from the bank. That's your safety net. Once you've got a safety net, then you can start to look at investing. So I would say either 6 months or 12 months bills and mortgage money in the bank, or whatever makes you feel comfortable in your mind. So that might be £10,000 to you. It could be 20,000 to Jonathan, whatever makes you feel comfortable. Once you feel that you've got that, then we're looking to make our money work harder by investing. And so while we're asleep at night, our money is making money, and that's what we're trying to do.
Thanks, Andrew, for answering all these questions. So now I'm going to hand over to Dr. Varaj.
Thank you so much, Zara. One last interesting question, I think, is on the chat box. You might have read it from Arslan Arif. He's asking that, is it beneficial to transfer NHS pension to HSE Northern Ireland pension and then bring it back to NHS if changing jobs between England and Ireland? What are you saying?
Yeah, we had that one. So I think that guidance should be from the NHS trustees, really. You'll have like an NHS pension helpline or help service to answer questions specific to deal with things like that. So I would encourage him to ring up and just talk through the situation and get the right answers before they make any decisions.
So is it from NHS helpline, is it?
Yeah. You'll have a specific website for the NHS pension, and then there's a certain helpline that you can ring up. We can get the number to you.
Brilliant. Thank you so much. I'll just pass it on to Dr. Habib Haider, the lead for education, to see if he wants to conclude it. And I think Mr. Irfan Akhtar is also here. So let's see what Habib has to say. Thank you, Habib. Thanks, everyone. Thanks all the participants as well as the audience.
No, thank you so much once again to all the moderators. Sorry. Thank you, everyone, for your contribution today. Sorry, we have immediate past president of APNE, Mr. Irfan Akhtar, has also joined us. I would like to ask him to say a few words, and then probably I'm going to say at the end to conclude. But thank you, everyone, for your contribution.
Hello.
Are you on the line? I think he disconnected or. I think he probably disconnected. So thank you so much, everyone, for joining today. And thank you, Andrew. Very nice and very informative presentation. I learned a lot. As Mr. Rice said, that is eye-opening for all of us, basically. I already had a one-to-one session with you regarding further advice and input in terms of mortgage and all those things. So I found really beneficial. I'm really sorry I'm still struggling to get hold of all the paperwork and get back to you, because as a doctor, it's always tricky for us to deal with financial things. And as I said, we are doctors of human being, and you're a doctor of finances. So we always need your help and input at every step. So thank you so much, Dr. Zara Iftikhar. Thank you so much for all your help and input today. And Dr. Vajia had to leave in between as she had to pick her son. So thank you, Dr. Vajia, for your input at the same time. And Mr. Wright, last but not the least, thank you so much for moderating this session and provided you valuable time today. I would like to ask a few words from Dr. Nadeem Raja at the end, and ask Jonathan Godfrey to say a few words. And I'll try to reconnect Mr. Irfan Akhtar as he probably disconnected. And meanwhile, if you can say a few words, Dr. Raja.
Thank you very much, Habib. Once again, all of you for organizing such a brilliant webinar. And I also thank you, our friends, Jonathan and Andrew, for giving us very useful financial tips today. And I urge to my fellow doctors to protect your hard earnings for your future by taking right financial advice from our financial team. So thank you very much, everyone.
Thank you, Rasab. And Mr. Irfan Akhtar is joining soon now. So I think he joined us now. So yes, Mr. Akhtar, to you.
Unmute,
Yeah,
please. Yes, now.
Hello, can you hear me?
Yes, we can hear you.
Yes.
Right, thank you very much. I'm not sure what happened, a technical glitch. All I was saying was that it is ever so important for
I think his signals are playing. He disconnected again. I can't see him on the screen. Jonathan, do you want to say a few words? Meanwhile, I'm trying to.
Okay, can you hear me?
Yeah, we can hear you.
Yeah, okay. Just to reiterate my thanks to everybody, and particularly to Andrew, because it's a very, very difficult subject to try and portray in this fashion. Sometimes face-to-face is better, but that will be for another day. As we said at the start of this is the start of a journey, and I wanted you to see and witness the expertise of, in this case, Andrew. And hopefully you agree with you know, his manner, his help. We're here to help. Please do not try and trawl 100 lenders for your mortgage. Give the problem to us, because it's what we do. You look after everybody, as we've alluded to. We'll do the wealth, you do the health, please. So it's very important stuff. And let me finish this session with this, please. This is one of the aspects of life that you've all listened to. I would hope a lot of you have agreed to. We should look at our mortgage. We should look at our protection for our ensuing careers. We should look at this. Please do not sit on it. Give us the problems. Let us help them. And then once you've got it, for example, a protection policy, it's one of these documents that goes in that drawer in everybody's house that everybody has, that, you know what, you go to for the rainy day. And I'll finish with, my beloved boxer dog has just had £10,000 worth of life-saving treatment that I couldn't have afforded to pay for her. But luckily, I do have that insurance policy that has done that. And that is the principle of what I would like to finish with just one last point. As the President, Mr. Amir Khan, said in respect of the NHS pension, that is a university degree and PhD on its own. But we have the presentation and we have the experience and expertise to specifically deal with every single question pertaining on a personal level to somebody's NHS pension. So please ask of us. Thank you.
Thank you so much, Jonathan. On this note, I will hand over to Mr. Irfan Akhtar, who's the main person who actually introduced yourself to us last year. And thank you for your contribution today. So Mr. Irfan Akhtar, over to you. Can you unmute yourself?
Can you hear me now?
Yeah, we can hear you now.
So all I can say is that I was saying was that I hope the technology doesn't ditch me again. But a wonderful talk, a very, very elaborative and very detailed. One needs to keep in mind that we all have got our individual circumstances. So it is very important that we take individual advice. There are a lot of messages which have come across, and the biggest is that financial planning is equally important as your career planning is. We span 30, 40 years in NHS, so it is only necessary that we spend some time and spend some effort on our financial matters too, as much as clinical. So on that note, I have got few questions which I think would be answered best by taking individual advice. So I will be getting in touch with you, Jonathan, in due course. And I would suggest the same to the junior fellows. You know, now that we are we are on the downslope of our careers, heading towards retirement, we are now sensitive to how important financial planning is. But the junior guys who are just starting their career, my advice would be to keep thinking about it as you progress on. So once again, thank you very much, Apne team, for organizing this very useful and a very fruitful kind of a meeting again. And I'm sure that this would be one of many to come. Thank you very much.
Thank you, Mr. Irfan Akhtar, for your input and contribution. And once again, as I said to you before, that we are a doctors of human being and you are a doctors of finances. We definitely need your help. And it's not the last seminar as we did. And I think lots of topic and lots of question arises around the pension. So we're definitely going to do very soon a pension seminar. And also we need your input for that too. Apne education team worked really hard, and we actually arranged different webinars in terms of health topics. And also now we started with a partnership with you guys regarding the financial matters as well. We also conducting a different things in terms of Apne Education Showcase. So please come forward, as I said you before, in terms of involved in various educational activities. And we also planning to do one-to-one CME workshop in different cities of UK. As the COVID is over now, so we have more opportunity. We're looking forward to our main Apne Health Seminar on 30th of September, which the detail will be shared with you guys very soon. And we're going to involve the financial talk during that session at the same time. So once again, thank you on behalf of my team and the whole Apne team, and especially Apne executives and all the moderator today and all the speaker. And hopefully you guys have a blessed day and enjoy your day today. Thank you so much.